So what are future contracts? We'll talk about that today in this basic or introduction class. This is just to give you some general information for all those that are maybe making the change from Forex to trading futures. Or maybe you're someone that's really just interested in trading futures. You have never traded any particular market before, but you're ready to now to kind of start diving deep into learning what you need to know about maybe shifting or making money in this business of trading futures. So today I'm going to be going over just the basic general idea of what a future contract is. We're talking about time periods in which the markets are open. We're also going to talk about like margins. We'll also talk about contracts, meaning, certain times, certain months as far as rollovers and things of that nature. So let's talk about, primarily what a future contract actually is. And to all the beginner traders out there watching this, please watch it to the end so that you get a full in-depth, a full in-depth basis of what we're talking about pertaining to futures. Okay. Now, a contract is a contract. You should got anybody who's in the who's ever maybe sold a car or bought a home or operate a business, whatever it may be. A contract is a binding agreement between, say, two parties, okay, two individuals. When it comes to future contracts in specific, you're basically stating that I am interested as a trader to buy or sell some particular asset, and that asset could be the indices or equities. It could be a commodity, it could be currencies, it could be a financial market, and specifically like the bonds. So you're agreeing, obliging yourself to say, hey, I'm interested in buying this particular instrument, okay, at a certain price to be able to sell or buy it or at a future date. Okay, so basically breaking that down, you're just basically stating that I'm interested in, say, for example, in buying two contracts on the NASDAQ future, which is the equities or index. Okay, these are derivatives. Okay, so I'm interested in buying two NASDAQ future contracts at a certain price, or wherever you want to get in at, whatever your level is, and I'm looking to sell it once price reaches whatever price of interest that you want to sell it at. So that's all it is when it comes to actual future contracts. It's just you agreeing to buy or sell financial derivatives. Again, it could be the indices, commodities, currencies, whatever it is, whether you're selling or buying, okay, at a certain price, all right? And then you're looking to maybe buy or sell it back at any given, period or time frame or date. So mostly day traders will looking to basically trade within the New York session, say for example, which opens up at 9:30 Eastern time, all right, and that's 8:30 Central time. So once the market starts moving around, we have opening, and then we're starting to, for traders, depending on the strategy you trade, you have a zone or a level of interest you're looking to trade from. So you say, I'm looking to buy at a certain price, all right, and then once the market gets to a price above you, you're looking to sell it back, all right. So that's basically all it is, but you're agreeing on a contractual basis. Now, if the market goes in your favor, then that's a plus, right? But part of that agreement, as well as if the market goes back against you, you're looking, you bought two contracts on the NASDAQ and it comes back against you, and you have a stop loss put in place, it hits your stop loss. Well, guess what? That's part of the contract too. You lost, you took a loss. That's part of the contract, that the risk at hand in trading futures, okay? So that's all it is. It's a binding contract, okay? When it comes to actual, let's say, for example, the equity markets or the indices, for example, we're talking about like the, whether it's the micros or the full-on E-minis, it could be the NASDAQ, the Dow, the Russell, the S&P 500. Those primarily, when it comes to right here, for example, I'm going to show you right here. You see the months right here? There's four contract months, okay? And each one of those, the HMUZ, represents each quarter within the year. So from January to March, all right, there's one contract. That's the H contract, okay? Then we have April, May, June, okay? That's going to be the M contract, all right? Then you have July, August, September. That's the U contract, the contract that we're in right now. And then somewhere in September, there'll be a date around the 15th or somewhere around there to where things will roll over. You have rollover dates. That's why you have each one of these contract months. The HMU, the last contract is the fourth quarter in the year, which is Z. So each letter represents 3 months over a quarter of a year. That's how we determine it in futures trading. So somewhere at the end of that third month, you should be looking to roll over as long as there's volume into the next contract. So if I'm in the M contract, well, let's say I'm in the U contract right now. At the end of that third quarter, all right, in September, I should be looking. You can go to the CME's website, and you'll see on their website, you find on there where there are specific contract dates for rollovers. Rollover means to where we're moving from one contract into the next contract where volume starts to pick up for that particular market. Okay, that's all it is. Okay, and then some of the other markets, maybe like say for example gold and some of the metals and grains, things like that, they may have front running contracts, meaning every single month there may be a new contract, so you may need to roll over each month. All right, but I primarily trade the indices. So if you trade the indices, again, that's the Dow, the Nasdaq, the Russell, or the S&P 500. We're talking about either the micros or the E-minis. We have 4 contracts in the year, 1 each quarter. Okay, so with that said, you can see here on my chart just as well, because people always are asking about tick value. Now, tick value, what that represents is depending on the actual market. Okay, for example, for every tick, every movement in the market. So for example, let's say the Nasdaq. Okay, we're looking at either the micro or the NQ. Okay, so you got the MNQ and then you have the NQ. We're talking about futures. Each tick. Okay, so in the Nasdaq, for example, there are 4 ticks in every point. All right, same with the ES. There are 4 ticks in every point. So every point is going to represent a specific dollar amount. So if the tick value, for example, on the E-mini Nasdaq is $5 a tick, 4 ticks in a point. So that means that every point mark, I'm making $20 or I'm losing $20, okay, depending on which way the market is moving. Now, if you go up to the micros, say, for example, here, the micros, it moves 10 times less, okay, in tick value, all right, in size, than the full-on E-mini. So for every tick that it moves is 50 cents a tick, all right, we get 4 ticks in a point. That's going to be $2. So it's 10 times less than the actual full-on E-minis. That's how, when we talk about ticks, all right, every time the market moves up or down, that's considered a tick in the future contracts, okay? So, and as you can see here, there's a list of different future contracts when it comes to, specifications that you can actually trade. Again, these are the indices, the equities down below here. You have the currencies, you have energies, getting down to some of the commodities, the metals. Then you have, these are the financials right here. But then you can move on down. You have grains, softs, meats, things of that nature. So, regardless if you want to trade the commodity, any means of a commodity or, the indices or the financials, just pick your own. You have to pick your choice of which market you want to trade. Now, let's take a look at trading hours, because people are always asking about what time does the market open up from opening to close, when is it reopen. The thing and the beauty about trading futures, especially when it comes to trading, say for example the indices, it's open 24 hours a day, okay, Monday through Friday. The only day the market is really closed is really going to be on Saturday, okay, because the market does open back up on Sunday. So it closes on Friday, reopens back up on a Sunday. Okay, so if we're talking in terms of trading hours, all right, say for example we're looking at the indices. The market, again, like I said, it opens at, say, Sunday, and it runs from, Sunday to the close on Friday, all right? So the market opened up at 6 p.m., that's Eastern Standard Time, on Sunday evening, okay, and it'll be 5 Central Standard Time, and it runs to, Friday at 5 p.m., okay? But you have to take into consideration, and best piece of advice is to get out or be out of the market by 4 o'clock, okay? As you can see right here, let's say I was interested in trading the micros or even just the full-on E-minis. You can see the opening time. These times are CST, Central Standard Time. If you're on the East Coast, then it'll be 6. Close at 4. Okay, but that doesn't primarily mean the market actually closes at 4. It actually closes at 4:15 for a halt period, which is a maintenance period for 15 minutes between 4:15 and 4:30. Then it reopens from 4:30 Eastern Standard Time to 5 o'clock. So it actually closes at 5 p.m. Okay, but to be safe on the safe side, that's why they have 4 here, because technically you want to be out of the market by 4 o'clock, because if not, then, there's going to be a requirement that you're going to have to meet with your broker, which is called a maintenance margin, and you don't want to be nowhere tied up in that situation there, because then the amounts increase as far as how much you need to trade or have in your account per contract to trade. So, again, 6 p.m. Eastern time on Sunday or 5 p.m. Central. From Sunday to Friday at basically 4 o'clock is the safe period, okay, to get out of the market. Then it closes at 5 p.m. on Friday, and then it doesn't open back up until Sunday at 6 p.m. Eastern or 5 p.m. Central, right? So that's the time periods there. Now, some of the other markets, say for like gold or the metals, they'll open like 6 p.m. Eastern, and then they'll continue running through 5 p.m. without a maintenance period, okay? So, again, these are the time periods here for anyone that's actually interested when it comes to looking at the future markets and which markets or which hours or time frames to actually trade them. All right, moving on to the last part of it. People always have a question about, which contract should I trade? Which contract can I trade with, a limited amount of funds? I'm just getting started. I want to kind of, get my feet wet. What do we recommend? Micros to start off with, if you're someone that's a beginner trader, just starting off, you learn the ropes of how to trade the correct way, understanding market structure and price action, and identifying, key levels surrounding whatever strategy you're going to trade. I trade supply and demand, so I'm interested in looking for supply and demand areas, all right, within the market. Now, if I was interested in trading the micros, as you can see, pay attention here, because these are the day trading margins right here, okay? Don't look at the maintenance. Maintenance is that period of time I told you that you have to have a certain amount. If you go past that 4 o'clock cutoff time frame and get into 4:15 Eastern Standard Time, you're going to be required to pay a certain amount addition to and having in your account per contract, and they can be significantly higher, okay? As you can see here, if I was interested in trading the micros past that 4 o'clock mark, when we get to 4:15 Eastern Standard Time, the margin goes from $40 a contract to $1,310 a contract. So that's what I'm talking about. All right. So day trading and intraday trading, the micros, it only costs $40 per contract, which means you have to have that in your account, at least that amount, to trade one contract. For every contract in addition to, you have to have an additional $40. And each one of the, below that, there is the contracts or the amounts for day trading margins or intraday trading margins for each one of the contracts you see right here when we get into the micros, okay? The full-on E-minis, as you can see, let's say the micro E-mini S&P 500 was $40 a contract. The E-mini full-on, okay, meaning the E-mini S&P 500, not the micros, is $40 a contract. $400 a contract, not 40. All right, the Nasdaq is 1,000, where it was 100 for the micro. The Dow is 500 a contract, where it was 50 for the micro, and then the Russell the same thing. All right, so understand you have to have, and these are the amounts per contract, which means you have to have this amount per contract in your account to be able to trade those particular size contracts you're looking to trade. So if I'm interested in trading, for example, 2 contracts on the E-mini S&P 500, I need to have a minimum of $800 in my account, or the micro, a minimum of $80 in my account to be able to trade 2 contracts, just as an example, okay? So and these prices may vary slightly depending on your broker. My broker that I use is with AMP Futures, not pushing or telling or advertising or marketing this broker in any particular way. I'm just telling you that pay attention to the broker that you're interested in maybe using, and find out what the margins are with them before you start, make a decision which way that you're going to sway one way or the other, okay? Do some homework, look at some different brokers out there. Pick a good trading platform and a broker to go with, is what I'm trying to say in the end. So this is what I'm talking about. If you're interested in getting started into the future markets and trading future contracts, or maybe you're watching this for the first time and maybe you're switching over from Forex into futures, this is the information that you're going to need on a basic or general basis in helping you get started trading the future contracts, okay? You can also find other information about future contracts over on the CME website. Okay, that's the Chicago Mercantile Exchange. You can go to the website and find out even more information if you want to. But do your homework and find out which platform, which broker you want to use. Look into all the details when it comes to the specifics, the trading info, like right here: margins, trading hours, specification, contract expirations, holiday calendar, economic calendar, things of that nature. These are all the things you want to know. I mean, it's not It's not tough information or whatever the case is. It's just basic information that you just need to know to be on gaining the experience and the knowledge that you need to know to be able to trade these contracts the correct way. Okay, but that's all I wanted to share to do today, was share with you guys. And this is basically how you can actually make money trading futures. Once if you understand how to trade the correct way and you have a certain strategy that works and you've been trading other markets, trust me, more than likely it's going to work in the future markets as well. So, you just come over and start, back testing and forward testing and get into the groove of, starting off and starting slow, put a little capital into your personal account and watch it grow. Okay, this is the way to generate and to make some daily income. So that's all I wanted to do, was share with you guys today this bit of information. Hopefully it helps out. If it does, please go ahead and smack that subscribe button. If you're not a current subscriber right now, click on the sub button. Make sure to turn on your post notifications so you do not miss one of the uploads here on the channel. All right. For anyone interested in joining the Discord, the link is down in the description portion of the video. For all those that always ask about how to join and become an elite member, all it is $6.99 a month, and what you get is access to the trade breakdown. So I'll walk you through trade setups in detail of trades I posted over on our Discord community, so that you understand where to place profit targets, where to put your stop losses at. Just talking about when it comes to trading supply and demand, the strategy, and as it is talking about certain trades as they are unfolding, so that you understand the strategy, how it works in detail. $6.99 a month is very inexpensive. That's on a monthly basis, $6.99 a month. So if you're interested in joining, becoming an elite member as well, the link is down in the description portion of the video as well, right below the Discord link. You'll see two links. The first one's the Discord. The second one is to become an elite member. But outside of that, that's all I have. I appreciate everyone tuning in. If you found value in today's video, please drop a like on the video. Take care. See you in the next one.